already know you can invest in other companies' bonds, you can hold them to maturity, right? We don't need to do investment in held to maturity bonds, do we? Right? We did that at the same time we did bonds payable. Right? Kind of makes sense to me to do one side, do the other side, get it done, right? Okay? So what's this? This is investing in other companies' what? Stock. I buy their stock. That's it. Okay, I'm buying their stock. Okay? And what's going to drive how we're going to account for it is how much stock you own. What percent of the company you own, which is going to determine how much control you have over the other company, don't you think? If I own one share out of 100, well, that's too many, out of 1 million shares of stock, oh, 10 million, maybe there are companies with 100 million, I don't know. Anyway, if I own one share out of 1 million shares, how much control do I have? What happens when I vote? Nothing. I have absolutely no control. I'm passive, right? Why did I invest in that stock? Because it's a well-run company and I want to share in the profits, right? That's it. That's why I would invest. But I'm not going to help run it. I have absolutely no control. But what if I own 100% of the stock? What happens when I vote? I think I win. I think I own that company. And what we'll do, if one company owns another company, we'll consolidate, which just means put them together. They just mentioned that in the chapter. I'll show you a little bit more, okay, real basic. Okay, so you have an idea what that is. Okay, now, so in between one share and 100%, there's a whole wide range, right? Okay, what we're going to do is we're going to talk about how much control I have. Right? Oh, by the way, can I also invest in a bond and not hold it to maturity? Could I invest in a bond or preferred stock and not have any control? Say non-voting preferred stock and bonds. Can I invest in those? Sure I can, right? So in those instances, I'm still a passive investor, right? In fact, a bond held to maturity, you're still a passive investor, but we know how to account for that already. What if I'm not going to hold the bond the whole time? I'm going to hold it between one day and, up through, I guess, a few years or something, right? But not the whole time of the bond. Now what is it going to be? It's a passive investment, that's all, okay? So it'll be handled exactly the same way I would investments in stock. Got it? Okay, except I obviously don't have any control at all. All right? Okay. So what are the critical things that we look at? The amount of control I have. So if I have one share up to what number, I say I have no control. And if you get this down, all of a sudden this chapter is not so bad. If you don't get it down, it's like, oh my gosh, what's going on? How can I possibly remember this? Again, you don't remember it, right? You know it, okay? No control is what? When I vote, my vote probably doesn't sway today at all, right? I don't have much influence. What is it?
7%.
Yeah, that's it. One share up to what? What's the number? 20%. And that's just a rough rule of thumb. If you own 20% of General Motors, wow, right? Wow. You'd be the biggest shareholder. You'd have a lot of control. So then in that situation, I wouldn't say I have no control, even 19%. You use your judgment here, right? But if you own 20% of Ford Motor Company, so what? Family members still control it. Got the idea? Right? So if you're not a descendant of the Fords, then you're not going to have any say anyway. Got the idea? So it really depends on the situation. But anyway, that's the rough rule of thumb. I'll always stay away from the 20, right? I'll be down at 10, 5%. You got it? So when you see a number less than 20, what do you think? No control. That's it. Okay? You got no control. Okay? So pretty simple, huh? All right? When would you say you do have control? When we vote, I win.
50%.
Yeah, 50%. So over 50%. So 50% plus a share, I suppose, right? Up to what? Of course, 100%. We call it a subsidiary if we have control. It's subsidiary to me, right? I'm the parent. The company that owns the other company is the parent, and then the subsidiaries. When you do consolidated statements, you put together the parent and the subsidiaries. Got it? This is really useful stuff to know. And like I told you earlier, I know this is in an appendix, but that's just silly. It used to be in a regular chapter. Why did they change it to an appendix? Because you guys aren't smart enough to figure this out? Are you kidding me? You're going to be reading financial statements all your career. Of course you're smart enough to figure this out. I have no idea what they were doing, right? And I even sent an email to the authors, and they didn't even respond. Right? And they made a lot of money off of this book. I think they're getting pressure to dummy it down. Make it not as tough, not so hard. Because your generation doesn't want to work, right? Bull. I was talking to a banker here in town the other day. He was lamenting the fact that young people, this new generation, just doesn't want to work. And I told him, you know, when I started teaching when I was 29 years old, people were telling me that young people don't want to work like we did, you know, when we were kids. Bull. I was lazy just like you. And then I decided I wanted to make a living. And I went to work, right? And I found out work was fun. You guys work hard at other stuff. Some of you work hard at playing on Facebook. You know, it's not Facebook anymore. Whatever you guys do. Twitter and Twitch tweeting each other. That's what it is, right? Okay, Twitter, that's what it is. Okay, anyway. Yeah, anyway. So whatever you're playing with now, you can spend hours and hours and hours goofing off with that, huh? Why not instead spend hours and hours and hours doing something that is productive for you? Right? You know what I mean? I remember when computer games came out. No kidding. It was in taverns. You ever seen these things? You know, it'd be a big, great big huge screen with a primitive computer, right? And they'd have Pac-Man moving around on it, you know, and asteroids. You ever seen those old things? And people would actually plunk money into these machines, you know, quarters at a time while they're drinking beer, right? They put quarters in there. And what are you doing? I have one of those things at work. It's called a computer. I get paid to play with mine. I am not going to put money into a computer so I can play with it. And I still feel that way about video games, I'm sorry. I do play video games though now. Not well, but I play them. You know why? Because I have grandkids. And I get to be with them if I play these stupid little games. But I'm already trying to convince them, hey, you can make money with this. Yeah, anyway, so quit playing, work instead, yeah.
How do you feel about pinball?
Well, that's different. Yeah, that's different. I got in big trouble from my dad because I was playing pinball when I was like 9. I didn't play a lot of pinball because I was putting money in a machine and I was working really hard and not getting paid when I worked. Yeah. So you see where my attitude comes from. Money's not everything, you guys, but God, it's nice. It just is. Okay. So anyway, this just makes sense, right? It's just not a big deal. Okay. So what's in between, obviously? If you got the 20 and you got the 50, gee, there's a whole range over 20%, right? Up to 50%. Everybody got it? That mid-range, you have what? You don't have control. You have some control, though, not no control, and we call it what? What was the term they used? It's a neat term. Significant influence. Does everybody get this? If you have those, you're on your way. Okay? It's not bad, is it? It kind of makes sense. And I don't know where the 20 comes from, really, but, you know, it's just a rule of thumb. Judgment. Okay? So it's really, do you have control? Okay. Then what we got to do is figure out what we call these things in here. Okay? I already said that what we're going to do over if you have control is what? We call it a what? Parent-subsidiary relationship. So this is going to be a subsidiary. And that's common sense, right? It's subsidiary to me. It's my subsidiary. Got the idea? I'm the parent. Guess what we're going to call it? What's the account going to be named? Cleverly. These are all investments. How about investment in subsidiary? You guys like it?
Yeah.
I'm going to call an investment in a subsidiary an investment in a subsidiary. No problem there. Okay? All right. What are we going to call it if we have significant influence? It's no longer a subsidiary, but it is a company that I'm affiliated with, huh? They're affiliated with me, I'm affiliated with them. Guess what we're going to call it? Investment in an affiliate. So these just make sense, okay? It's definition. All right? We got a different situation, though, if we're less than 20%. Now, oh, by the way, how long do you think you would keep an investment in a subsidiary? If I own more than 50% of the stock, you think I'm going to buy more than 50%, and then keep it for a couple days? I'm not crazy. If I did that, I'd lose a fortune, right? You buy all the stock and then instantly turn around and try to sell it, good luck, right? You're going to lose a fortune. How about if I own 20 to 50%? Same deal. You're buying that for a what? Long term. Those are long-term investments. What do you bet? So where's it going to go on the balance sheet? Under current assets or non-current? Non-current. It's going to be for more than a year. Got it, guys? It just makes sense that you do that. All right. Now, what if I own less than 20%? I own a handful of shares. You know, I've got some extra money. I invest it. The company does. I invest it, right? and I park the money there, and then later I'm going to sell it. Maybe soon, maybe later, right? Could I hold a share that's less than 20% for, say, a day? Yes. Could I hold it for 10 years? Yes. So it's all about your intent, how long you're going to hold it. Guess what you're going to call the ones that you're going to hold for less than a year? How about short term? Because it's a current asset. It is, isn't it? It's an investment in a current security, right? Marketable securities, we call it. Okay, it's marketable. All right? Okay? What am I going to hold it for? A day, more than a year, up to forever. It's long term. Got it? Very simple. So what do we call them? I have them held available to sell. What would be a really good thing to call an investment in an available to sale security? Security is an investment in another company, share stock. I think I will call it investment. This is investment in affiliate. This is investment in subsidiary. These are going to be investments in what? Available for sale short term, or that's what I'm going to hold, yes, less than a year. Available for sale, what? Long term. No kidding. Everybody got it? This is not hard. Now there's one other thing though. So we got this time period, short term, long term. We have one other one which is very short term. And we call those trading securities. So available for sale, investment in trading securities. Investment in trading securities. And that is kind of a political compromise. Right? How we account for it on the income statement. Okay? So we've got some new accounts coming. In this category over here, we have something that's kind of new, kind of strange. Okay. Here's what the deal was. Everybody agreed that we really wanted to show our investments in other companies' stocks at market value in the balance sheet. And it really is conceptually a great idea. It's a great idea. I think it is. It's a great idea. If I have an investment in Yum Brand stock, do I know what it's worth at the end of the year? Yeah, I know what it's worth every day. I can look up what it was sold for every day, right? Closing trading price every day. So if it's a publicly held company, do I know what the stock is worth? Of course I do. So shouldn't I put on the balance sheet what it's worth at the end of the year instead of what I paid for it? Especially if I've held it for 10 years or 20 years or something? Of course we should. But here's what the problem was. When we decided to do that, which I think is a great idea, right? When we decided to do that, people couldn't decide what to do with the other side. What do I mean by that? If the value increases, what you'll do is you'll debit trading security, increasing it, right? Or you'll debit available for sale short-term and the available for sale long-term. Got the idea? Because it increased in value. What would you do if it decreases? Well, you credit it. So that's easy. The journal entry is simple, huh? What do you do with the other side? And what I mean is, what do you do with the gain or loss? If it's a gain, everybody loves it, right? You debit available for sale short-term or long-term or trading security, increasing it, what would you get to credit? We call it an unrealized gain, okay? What does realized mean? I told you guys this. I told you lots of things. What does realized mean versus recognized? Recognized means that you record it in the financial statements, right? You recognize it with a journal entry. What does realized mean? You got the cash. You got paid, right? Or you paid it. We realize revenue when we get the money. We realize an expense when we pay it out. Right, guys? This is an unrealized gain or loss, what we call this thing. What does that mean? I haven't sold the stock. Now, you got to be careful with how you think about this. When the stock market went down from, I think it was about 13,000 to about 6,000 in a month, my wife almost had a coronary. We lost half of our wealth, right? And I told her we didn't lose it. What did I mean? Because she was planning, the house she's going to buy, the cars she's going to buy, what we're going to do in retirement. Probably what she's going to do when I'm dead and gone, right? Yeah, anyway, yeah. Okay, but what's the deal here? We didn't really have the money. It was only on paper. And we didn't really lose the money. It was only on paper. When do you really have the gain or loss? When you sell the stock. So it went way up. We made a whole bunch of money. It went way down. We lost a whole bunch of money. That's true, except I didn't sell a single share of stock. And now the market's not at 6,500 anymore. It's close to 18,000. What happened? Nothing. We didn't lose, right? We didn't gain when it went up. We didn't lose when it went down. Are we worth a lot more than we were back then? Yeah. Okay. You got the problem? You got the idea of the problem here? How do we record this thing? Well, I want to show the asset of what it's worth, but I don't know if I want to show that gain or loss on my income statement because it might be temporary. Got the idea? So here's what the deal was. At first, what we were going to do was we were going to make available for sale short term, have all the gains and losses hit the income statement because they were going to be soon. That make sense? It's going to happen soon. You're going to sell it soon because it's within a year. And then what they were going to do is they were going to take the gains and losses on the available for sale long term and put them into an other comprehensive income account. Remember we touched on that just briefly? In later classes we'll get at it more. But when you look at financial statements for companies, you will see an other comprehensive income account for their gain or loss on their portfolio. That means all their stocks, right? Portfolio, like a folder portfolio, right? The portfolio of all their stocks. You'll see that unrealized gain or loss on the available for sale stuff is going to be in other comprehensive income. It never runs through the income statement. Ah, do you want to look at that section? That part of their equity statement is where it will show up. Do you want to look at that and see how much money they've lost in the stock market? You'll see the gains and losses there, not in the income statement. The only ones that are going to hit the income statement are the trading securities. This was the political compromise I was talking about. People says, no, I don't want to show those because it might recover, right? If I have by the way, they don't mind showing the gain. They just don't want to show the loss, right? Human nature, okay? So if I have a loss, I don't want to show that on my income statement. Just let me put it straight into my equity because it's temporary anyway, which maybe it is, right? Okay? It probably will change on the long-term ones at least, and maybe even on the short-term ones. Well, then so people were debating how long, the new category then is trading security. The trading security is the only one that hits the income statement, okay? The unrealized gain or loss hits the income statement. So then the debate was, well, what do we mean by a trading security? How long would we hold it? So available for sale long-term is held for more than a year. Available for sale short-term is longer than a trading security, but less than a year. Got the idea? And then this trading security, that's where stuff gets complicated when people can't agree, huh? So you get a political compromise. It's hard to remember what it is because it's just politics, right? You decided. It's like tax law. It's what it is because people negotiated and came up with something. When you start doing taxation, you guys, well, this isn't logical. Why did they do that? Political power. That's why they did it, right? Negotiated and got a deal, okay? What's the deal with the trading security then? You won't believe this. It's one day up to a few weeks. That's what most people think. And then you know what most companies do? They decide they're going to hold their stock for more than a few weeks when they buy it, and they don't have trading securities. They call them all available for sale short term. Why would they do that? They don't want the gain or loss on their income statement. Right? Because what happens to the stock market, guys? It goes up and down, up and down, up and down. What would happen to your income statement? It goes up and down, up and down, up and down. And by the way, that makes you look riskier. So I don't want to hit their income statement. Right? In accounting 211 and in finance 315, we'll talk about that stuff. Okay? Right? And valuing companies. What do you look at how risky they are? It's called beta. Okay? Their variability in terms of their returns over time. Really valuable stuff. Okay, anyway, so the idea is, then what I'll do is I'll tell you they're going to hold it for a few days. What do you think it is? It's a trading security. What if I say they're going to hold it for 6 months? It's available for sale short term. What if I say it's 2 years? Available for sale long term. You're there. Got it, right? So here's the decisions. The first one is how much? What if I own, or if it's bonds, by the way, where would it go if it's bonds? We never have any influence or any control. Where does it go if it's bonds? Held to maturity, or it's one of these, depending on how long I'm going to hold it. Got the idea? Okay, that's if it's bond. Okay, if it's stock, though, what's the deal? If I own less than 20%, I'm in one of these three categories. If I own 20 to 50, I'm here. If I own over 50, I'm here, right? Everybody good? That's it. So the first thing you do is you look at what percent do you own. The second thing you do is if it's less than 20%, what do you say? How long am I going to hold it? How much and how long? And now we got it made, okay? We can do all the entries. And they're gonna make sense too, you guys, honest, okay? So guess what I'm gonna call it if I have no control? Debit what? Investment in trading securities, investment in available for sale short term, investment in available for sale long term. You guys can pull that off, right? And that's dependent upon what? How long I'm gonna hold it, okay? Got it. What if I own over 20% but less than 50%? I'm gonna debit what? Investment affiliate. By the way, what am I going to credit on all these? I'm buying the stock, you guys. Cash. Please get that one right, huh? Okay, that's a joke. Okay, of course. All right. All right, and then what am I going to call it if I own more than 50%? Investment subsidiary. By the way, you can put the company's name on it on any of these if you want, right? Investment subsidiary XYZ company, investment affiliate XYZ company, investment in trading securities XYZ company if you feel like it, although you don't usually group them all together, right? A bunch of different ones. Everybody good? So let's go ahead and let's record investments, okay? And then we'll record what happens in terms of the income, okay? Because they're going to make income over time. So the things we're going to want to look at is what happens if we invest, okay? Let's do that first. Okay, so let's say the company has, let's say the company we're going to invest in has XYZ company. They have 1 million shares. And let's say it's $10 per share is the market value. Okay? Let's say we've got that sort of a situation going. Okay? So if I've got $10 per share market value on 1 million shares, I guess the company's worth how much? $10 million? Okay. So in the first one here, let's say we buy, and, well, you tell me, up to how many shares could we be buying here? 20% of 1 million is what? 200,000? Okay, so I buy 1,000 shares. Where do you think I'm at, you guys? I think I have no control. What do you think? Okay. Or let's say I go out and I buy 300,000 shares. Now what do you think? I got 30%, right? Everybody agree? It's 1 million shares. If I buy 300,000, I got 30%. I got significant influence, okay? Or I go out and I buy 750,000 shares. I take over the company. I own 75%, okay? What are you going to call it? The day you buy it, okay? Let's do the journal entry the day I buy it, okay? So this is the purchase. This is my investment, the date of the purchase. What will it be? Investment in, we got to make a decision here, don't we? Yeah. All right. Investment in what? If I am going to hold it for what? Let's say I'm going to hold for 1 week. That's my estimate. Investment in what, everybody? Trading securities. We got it. How much would it be? $10 on 1,000 shares. What do you got? 10,000 bucks. What do you want to credit? Cash, 10,000 bucks. Even I can do this. Okay? What if we want to hold it for, say, 9 months? I don't know how I know that, but I'm predicting that. Okay. By the way, when you work as an auditor, this gets problematic because you have to look at how long they really did hold them. How long did they tell you, and how long did they? They're trading them every day or every few days. Come on, it's trading security. Right? They're trading them if they're holding for more than a year. It's not a current asset. It's a non-current asset. By the way, you might want to have more current assets, less non-current. You might be tempted to call it available for sale short term. It's really long term. But if they keep it year after year after year, give me a break, right? That's long term, okay? So anyway, but let's assume they're telling us the truth. We're telling ourselves, right? We're running the company, okay? So that we tell ourselves the truth. Hold for more than 9 months, investment in what, everybody? Available for sale short term. Easy, isn't it? How much would it be? Still 1,000 shares for $10, still 10,000. What would you credit, everybody? Cash, 10,000. Man, this is easy, isn't it? Okay. What if I hold it for more than a year? You know, I'll say 5 years or something. They plan to hold it. What would you do then? Investment in available for sale securities. Long term. That's it. $10,000. Credit. Cash. 10,000. Everybody got it? Okay. What would you do though if you owned? This is 30%, huh? By the way, what is 1,000 out of a million? What percent is that? 1/10 of 1%. Right? 0.1%. Is that what it is? I have the decimal in the right place. You guys are going over. I think that's what it is. 0.1%. 1% would be 10,000 out of a million, right? 10% is 100. Yeah. Okay. So 0.1%. That's tiny. I have no control whatsoever, obviously. Okay. What if I have 30%? Call it what? Investment in what, you guys, at the date of the purchase? In affiliate. Investment in affiliate XYZ company, maybe. All right. But how many dollars is it going to be? It's 300,000 shares at $10, you guys. What do we got? $3 million. Okay. Didn't leave myself enough room. Feel like that. Okay. What would I credit for $3 million? Cash? You got it. Or whatever I gave them. I mean, you give land, building, whatever, couldn't you? Okay, you use your cash. Okay, good. All right. Well, what's it going to be if I have 750? $10 a share. I bet it's 7,500,000. What do you bet? Okay. I bet I credit cash. You guys are going to get these points, aren't you? This was a good day to be here, wasn't it? Because I know when you read that chapter, it's kind of like, what are they talking about? You guys feel that way? I think I like this book a lot. I think it's really well written. I think this chapter, they really need to write it. This was fairly new stuff, I don't know, 5 years ago or something. They still haven't rewritten the chapter to have it make some sense, right? It's not very good, is it? Okay? But the combination of what they're doing plus what we're doing, you should be okay, huh? Right? Just get it straight, okay? All right, credit cash. And not that they said anything wrong, just not real clear, yeah, I think. Debit what? Investment in subsidiary. You got it. XYZ company. Okay? Everybody good? Okay, we're there. We got that done. Okay, then the thing that we need to do is handle them paying dividends and handle them earning money and handle the change in market value. Okay? So let's do all that for each of these. And this is going to be different based on what it is. Okay? Now again, where are we at here? This is less than 20%. This is 20 to 50%. And this is over 50%. Okay, got it? Everybody got it? Okay, so that's just to remind us where we're at. Okay? All right. So now what happens? Let's do all of these. Let's say that the market value at the end of the year we bought it for $10 a share. Let's say it's $12. Everybody got it? Are we happy about that? Yeah. We made $2 a share, right? Everybody agree? We did. We haven't sold it yet, so it's unrealized. But we made $2 a share. Okay? So all the way across, we're going to do that, okay? Just like we did with the purchase, okay? We have different numbers of shares, of course, right? Okay? So that's one. And then the next thing is going to be what? Let's say that the net income of the company, right? This is the net income of XYZ. Was it a $10 million company? Let's say it's $1 million. Okay? That's their net income for the year. Okay? All the way across. Everybody got the idea? Of course, it's the same company, regardless of how much we own of it. And then let's say their dividends, okay? Dividends from XYZ company, which are, some are going to be paid to me, right? To our company, we own it. Okay, we own part of it. Let's say the dividends are $400,000 of the million. Boy, they pay a lot of dividends out of their income. Okay, but that's fine. They can do that if they want. Everybody got it? Let's record these. And let's think about how much control we have. Okay? Now, the difference between passive and active, the author talks about, right? Passive and active investments. What's the deal with passive? I put my money in and I take whatever they give me. All of my investments are that way. Trust me, I don't own more than 20% of any company. Okay? Right? If you're any large company, you're pretty wealthy. Right? If you own more than 20%, even fairly small companies. Right? Okay? So I own a little tiny bit of a whole bunch of different companies. Right? Through mutual funds. Little tiny, I don't even know which companies they are. Savage. Okay? It's lots of them. Okay? Lots of companies. Anyway, I thought I owned some Young brands. I thought I owned some General Motors. And, yeah, you know, they buy all kinds of stuff. Okay, the mutual funds are there. Okay, so what happens if I'm just a passive investor like that? I'm taking what the market gives me. What do you think? If the market value changes, I think I'm either more wealthy if it goes up, less wealthy if it goes down. You guys agree with that? I think so. What happens with the dividend? I get the dividend. They're going to send it to me, right? So both of those are going to affect me, aren't they? Right? But what about the net income? Did I earn it? No. They're running the company. I'm just taking what they give me. So what I get is the change in market value. Got the idea? All right. Now, what's the deal, though, if I own 20 to 50%? In this case, it was 30%, right? We own 30%. Okay? Here it was 0.1%. That's how much we owned, right? Here it was 30%. And what do we say here? 75%. That's what we have. Okay? So we're in those categories, aren't we? Anyway, what happens? I am helping run the company. The net income is mine. The change in market value is nice, but I'm not selling the stock, am I? I own between 20 and 50%. Come on, I'm not selling the stock. So I'm glad the market price goes up. If we issue more stock, we, being I'm helping run the company, right? If we issue more stock, we get more for it because the price went up. Got the idea? But I'm not selling it. So I'm not going to show gains or losses from that. What I'm going to do is I'm going to show my share of the income. It gets even better on consolidation. Consolidation, I'm going to do nothing with it because I'm going to do something called eliminate it anyway. And we'll do that next time. So seeing as I'm going to eliminate it, I'm not going to record anything. You like that one? That's pretty easy, huh? Right? You won't have to do anything with it. Or I can record it and then eliminate it. Doesn't matter. Okay? So we'll talk about that next time. All right. So if I'm not running the company, I record the market value change. If I am running the company over here, I'm going to record the net income. Okay? That's the big difference. I'm going to have to record the dividend no matter what because I'm getting the cash, right? But I record it differently. Oh, the dividend's going to get recorded differently in both places. All right? So let's give this a shot. And this is where it gets kind of scary. Okay, what do I do? Let's first do the affiliate. Let's first do the affiliate because it is kind of a little bit easier, I suppose. What are you going to do with the market value? The market value change at the end of the year if it's an investment in affiliate. That's this one here, right? Investment in the affiliate. What am I going to do? You're going to love this one. No entry. I'm not just taking what the market gives me. I'm glad. I celebrate if it went up. I feel bad if it goes down. But I'm not investing for a change in market value. I'm investing for long term. Okay? Guess what if it's a subsidiary? No entry, same thing. Oh, this is nice. Okay? Let's do the net income then. What would I do with the net income if I have an investment in an affiliate? How much of the net income do I own? I own 30% of this company. It's $1 million in net income. Guess how much I earned? I ran 30% of the company, sort of, right? Got the idea? At least I own 30% of it, so if they have $1 million in income, guess what? Their retained earnings goes up by $1 million. What's my share of that increase in retained earnings? It's $300,000. I got 30%, right? So what I'm going to do is I am going to debit what? Investment in affiliate. Oh, what am I saying? I have, what is it? There's $1 million. I have 300,000 more investment, right? My investment goes up by that $300,000. You guys good with that? Okay, what did I pay for the $3 million, was it? And now it went up by 300,000, it's 3,300,000 now? Everybody good? And then I have to credit something. Well, on my income statement, I'm going to call this income from affiliate. Got it? So I have more income, and that's hitting my income statement. Income from investment in affiliate. Equity interest in earnings of affiliate. Is that what the author called it? Something like that? It's my equity interest. We call this, by the way, the equity method. Okay? We are using the equity method. So this is going to be the equity method. It's like a heart. The equity method, right? This is what? Consolidation, I said. Okay? And what we're doing over here on the trading securities available for sale is the market method. I should have said that earlier. I apologize for that. So when we say it's equity in the earnings of the affiliate, right, it's our equity. Okay? So equity method, I have a significant influence. Market method, I have no control. Consolidation, I have total control. Okay? All right. So when you debit the investment in the affiliate, you're increasing the asset. When you credit income of affiliate, you're increasing your net income, which increases your retained earnings. And if it's a subsidiary, guess what? You can do no entry. I like that one so far, don't you? No entry twice. All right. Then what would you do with the dividend? What would you do with the dividend, gang? If I have the investment in affiliate, you know, they gave $400,000 in dividends. I own 30% of the stock. What did they give me? They gave me 30% of the dividends, which is what, 120,000? 400 times 0.3. Okay. What are they going to give me? Cash, of course. You debit cash. You can do that. And credit what? Okay, now think about this one. I reflected their earnings here, right, as income. Should I reflect the dividend as income too and double count it? I don't think so. So here's what you do. Look, I recorded the earnings. My share of their income is an increase in my income, right? Increase in my retained earnings and an increase in the investment hub. And then, and remember, I'm helping run this company. Then I decided to pay myself a dividend, right? When I voted, right, to pay myself a dividend with my 30% of the stock, what am I doing? I am reducing my investment, aren't I? Oh, so I'm going to debit cash for 120, but what am I going to credit for 120? I increased my investment by 300 because they earned 300,000, right? My affiliate. And now I'm taking out 120 of it. That's what happened, right? If you have an investment that goes up by 300 and then you take out 120, isn't that what's going on? So I credit investment in affiliate. Do you got it, guys? Is this making sense? I invested $3 million. I earned 300,000. It's now 3,300,000, right? And then I take out 120 of it. Now it's 3,180,000. Everybody good with this? This makes sense, doesn't it? And then where it'll drive you crazy is when you switch to less than 20%, right? Because all of a sudden we're different, right? And the reason we're different is we don't have any control. Okay? So what are you going to do if you don't have any control? What's dividends to you now? I'm just taking what the market gives me. What's dividends to me now if I have no control? It's income. Got it? No control is going to be dividend income, dividend revenue, or dividend income. Okay? So what's it going to be in any case here where I have, this is no control over here, right, guys? I have 1/10 of 1%. So what kind of dividends am I going to get? What are the dividends per share? It's $400,000 divided by 1,000,000 shares, was it? What's that, 40 cents a share? And I have 1,000 shares, what am I going to get? 400 bucks? Or you could take 1/10 of 1% times 400,000, what would that be? It's 400 bucks. Right? Everybody with me on that? You guys have really developed your analytical skills this semester, haven't you? Isn't that cool? Nice, isn't it? When we started this semester, you thought I was a madman, didn't you? Well, you still think that. But you thought there's no way you could keep up, huh? Now what? I'm 65, you guys. You could really easily keep up with me, right? I've killed more brain cells, right, than I have left. You know, bourbon, pot. Come on. I don't smoke pot anymore. That's when I was your age. Okay, but yeah, you know. So you guys still have most of yours left, don't you? Don't kill off very many of them. Don't do that, okay? Try to generate more than you kill off. Yeah, okay. So, anyway. You guys wouldn't do that, of course not. Anyway. So, what do? I think we got, how much? $400. I think that is going to be debit what? Cash. Debit cash 400. What do you want to credit? This is earnings for me, right? I'm not running this company. I'm just taking what the market gives me, the market method. Credit what? Dividend income or dividend revenue, whichever account you want to use. Got it? There are no expenses that go with it, so I guess it's really dividend income. And what financial statement is that thing going to go on? Income statement, of course. Okay? Got it? All right. Now, it's going to be more complicated. Oh, by the way, what am I going to do with the net income? Let's do that one next. That's the dividends. What will I do with the net income? No entry. Why is there no entry there? I am not running the company. Right? I'm a passive investor. Everybody good? What am I going to do, though? This is where it gets difficult. The market value stuff. What's going to happen? That increase in market value was $2 per share, right? How many shares do I have? I have 1,000. How much richer am I? $2 a share on 1,000. $2,000. Everybody agree? So my investment was 10,000. Right? It's $10 a share for 1,000 shares. Now I have 1,000 shares that are worth 12. What's my investment? 12,000. Everybody agree? How do I make that account be 12 instead of 10? I think I'm going to add 2 to it, right? Debit it for 2,000. That's it. Okay? But this is going to be an unrealized gain, isn't it? Why is it unrealized? I haven't sold the stock. Got it? When I sell it, what I'll do is I'll debit cash, right? Credit the stock, whatever account it's in, right? Investment in trading securities or investment available to sell short-term or long-term. Credit that, and then I'll recognize the gain or loss, right? That's what will happen, okay? That's when I sell it. And we've already done that kind of stuff, haven't we, with assets? Gains and losses on assets. Okay, so the problem is we got 3 different categories, don't we? What if I called it a trading security in the first place? What am I going to call, where am I going to put the gain? What account am I going to increase? If you put it in investment in trading securities, what are you going to do now when you increase the account? How about debit investment in trading securities? You guys agree with that? What if I originally put it in investment available to sell short term? Well, of course, increase that account. Okay? What if I put it in investment in available to sell long term? Well, of course, increase that account. By the way, what if we went down in value? I'd have to reduce that account. And what would I have? Instead of an unrealized gain, I would have an unrealized loss. You got it, guys. And gains are what? Debits or credits? Credits, of course. What are losses? Debits, of course, right? It's worse, doesn't it? You guys already know how to do all that. Okay. So you can kind of see how they want to leave this chapter out because, of course, it gets too long, doesn't it? Am I covering way too much material in this class? Yes. Do you want to do 2 financial accounting classes or 1? I'll take 1. Your time's way too valuable, huh? Just wait till you're an intermediate. It's insane. Why do we do that? Because we don't want you here for 5, 6, 7 years. Right? 4.5's plenty to get 150 hours done. I'll start making 11 maybe, right? Or do something else at least, right? Never has to listen. All right, so what are we going to do? Investment in trading securities, right? Investment in trading securities would increase by how much? $2,000. And what do you want to credit? An account called unrealized gain on trading securities. Got it? For the 2,000. Everybody good? So is that easy enough? Now here's the thing. Where does that unrealized gain go? Remember there's a little discussion I did at the beginning about the political compromise? Where does that one go? These are things I'm going to hold for, a day up to maybe a few weeks. It's going to go on the income statement. This one is an income statement account. Might be a multiple choice question for you or something, right? It's an income statement account. Got the idea? What am I going to do if it was an available for sale? I'm going to debit investment in available for sale securities, either short term or what? Long term, depending on which kind it is, right? Whatever I originally put it in. Everybody got the idea, depending on how long I was going to hold it? That'd still be for the 2000, wouldn't it? If that were the scenario. And I'm still going to credit unrealized gain, unrealized gain, on what? Available for sale, either short-term or long-term. Got the idea? Does that make sense? For the $2,000. But here's the kicker. What kind of an account is that thing? Other comprehensive income. In other words, it goes straight to equity, to other comprehensive income. It never hits the income statement. And that's the whole world, you guys. Okay?
What about dividends for subsidiaries?
What about what?
We can do that over 50% for the dividends.
Ah, over 50% for the dividends, we'd still have to debit cash and credit investment in subsidiary. Because we got to debit. Oh, by the way, what would be our share? 75% of 400,000 is what? 300 grand. Why would we have to do this entry? Because we got cash. And then you know what would happen? Oh, by the way, you could do it that way, or you could go dividend income. Either one. And you know why I don't care? We're going to eliminate it either way. Right? So when I give you a subsidiary, I won't have dividends. I'll leave it out. Keep it simple. Okay? A little bit. See you guys. This was a good day to be here. Glad you showed up.